Welcome to the Financial Rundown. We're back. And today we have a special co-host guest, Mrs. Madeline Stratton.
Hello, CJ.
Awesome. Happy to have you.
Nice to be here.
Great. Looking forward to a good conversation.
I can't wait.
Awesome. Okay, so what do we have to start with first?
Oh my gosh. First, we're starting with, have you seen the Welcome to Canada CTV News video that's been going around on social media?
I have, yes.
Yeah.
An unfortunate story in a number of ways.
Yeah, so let's break it down here. So what happened is there's a husband and a wife. They came to Canada. They saved so diligently. They did such a great job. They built up their RRSPs. In 98, they bought a family cottage. And then about 5 years ago, they sold their primary residence. They moved to the cottage as their principal residence. And unfortunately, last year, they both died.
It was close. They both passed pretty close
in the
to each
same
other.
calendar year. So the first person passed away, and then there was the spousal rollover of the RRSPs, and then the second person passed away in the same calendar year. And tell me a little bit about how you feel about that video.
How I feel about that video, yes. Well, obviously, it was a sad story, and it was sad, obviously, losing both your parents that close it would be tough, I'd imagine. But also sad in the sense of, I think it was a bit misconstrued with the headlines and the article and the bullet points. I know they did have a CFP professional come on at the end to describe maybe what could have been done to avoid the big tax bill that they got. And you know, when you have an investment property like a cottage, then you have the gains and you have to pay them. Now, because they had a change of use in 2020, they delayed paying that gain until they passed, when then they had to pay it. And then obviously the RRSPs, they are taxable income, and so that goes on your final tax bill of the last person to die. And usually, depending on the amount, it can be taxed at 53%. So that's how, you get this big tax bill. However, I think, you and I work with clients all the time. Start early, start now, put that roadmap together. And we have a great tool, which I wanted you to talk about.
Yeah, actually, that's one of my most favorite things to do, is to use this conquest planning tool to really we could model so many things on there, right? So a lot of people, when they're planning for retirement, they think about accumulating and save. And I think that the article or like the video, the story doesn't do a great job at highlighting some of the other options that we have, and it really demonizes RRSPs.
Yeah, when you did demonize it when she was like, RRSPs are bad, and I think my mom's looking down, smiling at me because I'm delivering the message to everybody that RRSPs are bad. And that's what frustrated me, to say the least, and was that every situation is unique, and you can't just blanket say RRSPs are bad, because they can work for some people. And I think, back to the plan, if you have it, then you can take advantage of it.
Like, RRSPs aren't bad. They can be right for the right people in the right circumstances, but it really takes that planning piece, and that's really where you and I come in. That's where we meet with clients, and then we leverage our conquest planning software to model. And we don't just model when you are going to expire at 91, right? We're also looking at what happens to all of your money and the wealth that you've accumulated when you expire at 60 and 65 and 70, and making sure that we early on have time to implement strategies that are going to help you achieve your goals, right?
I think it's a cool visual when we go through it with clients, and it just shows, hey, here's your legacy, and here's what your legacy is made up of. So whatever investments you have remaining, properties you have remaining, etc. And then it gives you an
estate shrinkage.
Yeah, an expected tax bill that you're going to pay at the end, right? And so that's one where it's an eye-opener, because when you click that, like, exclude total taxes paid and exclude the year of death, you see your taxes paid through the years, but then you go include the year of death, and then sometimes clients have this major tax bill at the end, And then we go, well, hey, good news, you're here. That's what we're here for. Let's put a roadmap together and implement some strategies that can reduce that tax bill, keep more money in your pocket, and lessen the government's at the end of the day, or to your beneficiaries.
Yeah, I think, one of the good things about this article, if I can point out one good thing for sure, is that it's getting people talking about it and gives us a chance to sort of talk about like, yeah, that was a really bad situation. And I feel bad for them. And I'm glad that they've shared that story so that we can start the conversation early, because the truth is it takes some planning, right? And it does mean that we need to start a little earlier. And it gives us the opportunity to do that. So it sucked people in. Yeah,
and clients are saying, oh, like, we wanted to ask you, is there anything we should be doing here? Because we don't want that to be us. Great, let's get in and let's be talking about it if we haven't already. And going into our next topic here, politics and the political noise. It's a part of all of our conversations. It's impossible to avoid if you have a cell phone or a TV or any screen around you, a computer. You're getting the headlines and those, and they're just often very polarizing and negative. And so what we wanted to talk about here was taking a look back at an interesting chart that I found, which was looking at the US presidents and how the S&P 500 has done over the last, going back to the 1900s, and taking a look at Republicans versus Democrats and how the markets performed. But the message here really is that markets go up in the long run, and whoever is the president, Republican or Democrat, doesn't have as much of an effect on the market one way negative or one way positive more than the other.
We've had some clients come in and say, should we take our money out of the market while Trump is there? Like, he is so unpredictable and the markets are volatile, and should we take that out? And I think that the chart does a great job of showing like what we should do.
And that's focus on the focus on the long term. Focus on your time horizon, your risk tolerance, and the fundamentals. And I think it's been interesting to hear clients that don't look at their portfolio on a daily or weekly basis coming into the office and going, oh, I'm scared to look. And the market's been positive this year after a good bounce back from April, but it's been positive this year. And I'm always surprised at how they believe they've potentially lost money when the market's been doing so well, just because they're getting bombarded with those political headlines and they can't think that possibly the market's up with all the negativity around.
Talk to me about what's happening with unemployment here.
We had some bad numbers come out for Canada specifically in the last couple of months, where unemployment rates have gone up, climbed around 7%. Ontario is at 8%. Toronto's at 10%. And I think even worse is the youth crisis, and that's evolving here, and that's gone up to 14 to 16% nationwide, but 16% here in Ontario of youth unemployed. What it is it's taking a toll on young people that are already losing a little bit of hope with the rising cost of houses, the increasing costs of post-secondary education, and I think when we have clients coming in, younger clients, you can sense that little bit of defeat in their voices. And it's tough because young people should have the most hope for the future. They have their whole lives ahead of them. And so it's tough to see that. And these numbers don't look any good. So, the entry-level jobs, they're very competitive, and there are not as many available now. And I think that's why this number is going higher as well. And it's just, it's tough seeing clients come in. I sense that defeat a little bit.
Yeah, actually talking about the parents, I think, we definitely hear the parents talking about it. We see the youth, like the early adults, having some challenges. And I think that there's some things to keep in mind here, right? Is like from the parents' perspective, it is important to, make sure, I don't know if you heard that term, bed rotting, but it's really important to make sure that like we're not allowing that to happen, right? And there's lots of different ways to show up for our youth who are maybe having some challenges through some of those times. I think it's important for parents to encourage their children to get up and get out there. Like, think about how you got into this, right?
Yeah, and it's I think leveraging your networks and your, for the parents, they've been around longer, they know more people and have a bigger network. So it's both the kids and the parents, and making sure that you're leveraging that network to try to potentially get a job. We were talking about 20 years ago, I met Jerry and through pickup hockey, and never did we talk about, became great friends, but never did we talk about working together. And all of a sudden, 7-8 years went by, and then an opportunity came up, and that's how I started working with Jerry. So you never know what your network is, and that was through my uncle Tim that had introduced me to Jerry with the hockey. So you just never know what silly little thing could create that, whether you're, and you and I have kept in touch through getting to know each other, working together at Scotiabank through the years, and then, never knew an opportunity was going to come up or not, but we stayed in touch as friends, and then this opportunity came up as well. Yeah. And biggest blessing of your life, I know, but it's about, I think, making sure they're getting out, not just laying around in bed, and trying to do something. Like, even if you're a waiter or a waitress, you never know what regular comes in, gets to know you, and sees your work ethic, sees your attention to detail, and offers you a job doing something else. But it is tough, though. But I think you want to be out trying to do something. You can't just be sitting around.
Yeah, I think that's true. And yes, it is hard. It's hard out there, and there's lots of headlines, and we keep getting fed that information. But I think if we maintain some optimism and they continue to go out there, you never know where that opportunity is going to be. And it's not necessarily going to look exactly like what you had pictured it to look like, but it's gonna, going out and finding jobs and doing jobs. Like, you will meet people, you will accumulate experience, you will have space on your resume, and think about like transferable skills as opposed to necessarily that
what you went to school for,
and what you went to school for.
I think it's being open about the money conversation as well, and sharing maybe some struggles or some experiences that the parents have had with the kids, to say, hey, this is real life and you're not the first person to be going through this. I'm a big fan of getting parents to have kids that maybe they're not paying rent, but they're, as we say, 40's the new 30. Obviously.
Yeah.
And 30's the new 20, in the sense of kids aren't moving out at 20 anymore. They're moving out at 30 now. Right. And sometimes not even. But make sure your kids are taking advantage of getting a break on rent or not paying any rent, and saving money. Don't let that year or 2 years of them living at home, don't let them squander that and just blow money. Make sure they're coming in, getting a plan, putting aside some money to get them further ahead, and take advantage of the opportunity that the parents are providing kids with maybe a bit of a better deal on rent, and I'm sure food comes along with that as well.
When they have that gift of being at home, and when you get into your 40s now? 30s?
I don't know what. I'm not in my 40s yet. The heck
no,
are you
40's
talking
the new 30,
about?
right?
40's
so
the
you're
new
still
30.
in your
Yes,
20s. Yeah.
yes, yeah. Technically, yes. And
some, yeah, because 30's are the new 20.
I don't feel a day over 37, so.
Yeah.
So the numbers don't look great for the unemployment, and hopefully that turns around. But I think the youth should keep their heads up, stay positive, keep grinding away, and try to leverage those networks to get opportunities, and everything's going to work out.
So what is actually going on in the market?
I think to zoom out, to answer that question, because to lead this in, it's a beautiful segue that we've built here. There's politics, there's the economy, and there's markets. And you would think on the surface, when you look at those, that there would be very intertwined. But I find that the economic indicators are usually looking backwards, or backwards looking. And things like unemployment is showing us what the unemployment rate was last month. Inflation, what was the inflation rate last month? So there's some leading indicators, but oftentimes they're more lagging ones that get the headlines in the news, right? Yeah. And then politics arguing for these bills, spending money here, cutting money here, raising taxes, cutting taxes, so that you get a lot of headlines that way as well, which those two things, economic indicators, the economy, and politics, can have an effect on the market, but it's not as big of an effect as you may think. We saw on April 2nd, Liberation Day, all the tariff conversations where the market dropped. And so obviously the market was affected by the potential change in policies. But as the dust settled and some more certainty was brought with some agreements being made between countries for trade, we saw the market bounce back faster coming out of that April thing. So all that to say that the market is a more forward-looking vehicle where they're looking at, what is these stocks, what is this company going to look like 12 months down the road, 18 months down the road, as opposed to in the moment, in the present. So I think that that's important to look at that and say there's been bad political headlines for the last year, and there's been some bad economic news. There's been some good economic news as well, but there's been some bad economic news there. But the market's been resilient and still positive. So we have to keep that in mind when we're being bombarded with political headlines and negative economic news, that the market is a forward-looking tool there. One of the things that it's proven by is looking back since 2019, we had some data here that the S&P 500 has 125% total return since 2019, and 76% of that is driven by earnings. And so we talk about the bubble potentially and how that might look. It's not as much speculation though, because earnings have been so positive. So when we're talking with clients about is there a bubble? Is it going to pop? We're at all-time highs, etc. I think it's important to look at what has been driving the market returns has been earnings, which has been positive. That means companies are doing well, they're making money, and it's not just speculation not as much speculation, I guess I'd say.
Yeah, actually talking about earnings, recently I had a client who was worried that the price to earnings ratio was getting a little high, and was there still opportunity in the market, and that now might not be a great time to be there. So can you explain a little bit about price to earnings ratio?
The price to earnings ratio, yeah. So the price to earnings ratio, let's say the price of the stock is $10 and the earnings per share is $2. Then the price to earnings ratio would be 10 divided by 2, it would be 5. So that would be you would hear the headline that stock is trading at a 5 times multiple of their earnings per share. And I think where it gets, so to look at it on the potentially negative side, the more speculation side of it, if your price is going up dramatically and you're earning faster than your earnings are, you could have your price trading at 100 and your earnings being 2, and then you have a 50 times multiple, which is a much higher multiple out there, right? And on the flip side of that, you could also have lower earnings and your price still higher, so now your earnings per share is low, and that's not a good sign either. So you need to dig a little bit deeper and look into that. But I think the historical average is probably around 18 to 20 times your earnings per share. And value-based investing would look for lower multiples than that 18 to 20. And more speculative growth investing would look at price to earnings ratios, multiples higher than that 20. I think it's around 30 on the cap-weighted S&P 500 index is the average PE.
And so it's good news then that when we think about the market return, 76% of the S&P 500 return over the last 6 years since 2019 has been driven by earnings generated from those companies. Yep. I think the other thing that is important to note is that the price to earnings ratio holds virtually no correlation to the future rate of return on the S&P 500 over the next year. So it's not necessarily a great leading indicator of what might happen in the future.
It's a headline grabbing indicator, but at the end of the day, the historical data at least shows, which we know our disclaimer,
Yes, best. Just because it happened in the past doesn't mean it will happen going forward.
Past performance does not indicate future performance,
Thank
but future results or whatever that is.
Yeah.
And so we want to keep that in mind. And I think we want to keep that in mind, but we don't want to make decisions based off of that. And I think we're a big fan of active investing. The cap-weighted PE looks a little bit stretched, but the equal-weighted PE on the S&P 500, so all that means is when you have NVIDIA becoming a bigger and bigger chunk of a bigger and bigger weight of the S&P 500, its PE ratio becomes a bigger weight of that average PE on the S&P 500. But when we divide it down by the equal weighted index to get all 500 companies with an equal weight, there's opportunities there because the valuations aren't as stretched. They're more reasonable. So there's more opportunity there for active portfolio managers to find fairly valued companies that have a better potential return in the future. And that's where, that active portfolio management, those active funds can provide value during times like this.
Yeah.
During client meetings, we also get the question, is now the time to be investing? The markets are at all-time highs, TSX, S&P 500, NASDAQ, and other investments are at all-time highs as well. Gold is doing quite well over the last little bit, to say the least. So is it now the right time to invest? So we wanted to take some time. We're getting this question a lot. We wanted to take some time to do some research on our end. And I love seasonal data, so I have some good stuff at the end of this one. But I think it's, how do forward returns look after all-time highs are hit in the market?
Yeah, I think that a lot of people ask themselves that question of how high can this continue to go, right? And here's what we know to be true, that after a 5-month win streak, looking forward, 29 out of 31 times, the market continued to be positive a year later.
And I think that's not to say what it could do in the short term. We could get corrections in the short term, right? But I think it's a positive note that historical data is there supporting us in this, and that the saying of when's the best time to plant a tree was 20 years ago. And if you didn't 20 years ago, it's today. And I think that rings true here from the sense of we're not investing money for the next 3 months. That's not how we operate. So if you have a 5-year time horizon, no one's going to remember the correction of Q1 2026 5 years from now. And knock on wood, hopefully we don't have a bigger correction there, but it's a good positive sign that we can continue to get clients' money invested, continue to get your money invested for long-term growth.
Right, and we are not making short-term investment decisions to reach our long-term investment goals, right?
And there's with clients as well, we can take advantage of dollar cost averaging too. So if a client's a bit nervous about getting a bigger lump sum invested at all-time highs, we can take advantage of dollar cost averaging, keep that money in cash, and then strategically deploy it, on a monthly basis for the next 6-12 months to average our way in, so that if we do get a correction, we're buying low at that point, and then hopefully a year from now, as the numbers show, we're positive higher.
Yeah, and I think that's true. That dollar cost averaging, and I mean, we leverage that all of the time in many different scenarios. When you think about those small regular contributions, if you have a bigger amount, it's really about developing a plan and then sticking to it through the times.
Yeah, and I'm going to read off a couple of my numbers here just to keep it, we're positive vibes only here on this podcast always. So Fed rate cuts, so we recently had a Fed rate cut. Fed rate cuts within 2% so this was interest rates, so Fed rate cuts within 2% of an all-time high have led to positive one-year returns in all 20 historical instances. Which
100% of the time, CJ?
Which supports optimism for policies environments. Q4 has never been lower when new highs occur in August, September, and at least once in October, indicating potential for year-end strength there. So my buddy Ryan Dietrich, he's got a couple of good stats here that I always love following him. And new highs, especially in typically weak months like September, back to my seasonal research that I love. So September is usually a weak month, but it was positive here. So new highs in weak months like September signal bull market momentum. So again, with all the negative news and headlines out there that we see all the time, there's some positive stuff there as well, and that's what we're here to deliver for you.
This chair's been shrinking.
There you are. You're back up and at 'em. There you go.
Okay, for our last segment here.
So our last topic, we like to talk about recommendations, what you've been watching, what you've been listening to, what you've been doing over the past little bit. So tell the people a little bit more of a personal note or a little bit more about your interests. So.
Yeah, it's kind of funny. Today we were talking a lot about things that are happening in the news. We got the Welcome to Canada, we have politics, unemployment, what's happening in the market. Like, there's a lot of noise out there, and it always brings me back to reflecting on this book that I read called The Power of Habit. Can we put a picture up here?
We can put a picture up, yes, as long as you ask nicely.
I can't remember what the author is in this moment, but that book is about a lot of things, but one of the things that really makes me think about it during this time is, why are we hearing all of this noise? And that noise is really trying to distract us from what's important, right? And we talked about it earlier. When you're feeling overwhelmed and lots of stuff going on and you got all this noise coming at you, touch grass.
Yes.
Go touch grass.
Yes. Yeah.
Right. So stay grounded in your own goals. And so this book really reminds me that, that a lot of this is marketing. They're trying to influence us. They're trying to change our behavior. And it's really important to have a solid plan and look inward, take a deep breath, and just know. And if you don't feel like you have a solid plan when it comes to these things, then talk to us.
Yeah, talk to somebody, and yeah, for sure. I was with a former colleague, I won't name any names, but on that note, his phone, we were out for dinner and a hockey game, and his phone kept going up with BBC news articles, headlines, Apple News, CNN, Fox News headlines. Like he had them all on there, but it was just a bombardment of headlines being delivered, pushed to his phone, and I'm going, that's probably not, like, you don't need that but it's, to your point, it's there to get clicks, to drive ad revenue. So what's the ulterior motive there?
Why do they want me to know this?
And do you need that latest update at that exact time? Do you need that push to your phone, or is it something you spend 20 minutes, 30 minutes a day, and you go, hey, you know what? I'm going to catch up on the latest articles that I like to read.
Yeah, and you're sure you don't want to share who your former Philotimo Wealth colleague is?
Well, if you know us, then you could probably guess, because there's only one former Philotimo Wealth colleague around here. Yeah, and on that note, mine is a little less serious. I was at the Leaf game last night, so the Leafs won, and so Leaf season started. So we're back, sports season, and I like to make this joke that my favorite show, the new season of my favorite show, just started, and that's the NFL season, and it's on Thursdays, Sundays, and Mondays, and so that's great. Back into sports, back into fall, love the fall time, and looking forward to getting back into this now that the summer's over, getting back into doing some more podcasts. I have some good guest podcasts coming up. Hopefully we can keep doing the rundown here and providing value to clients, good information, hopefully.
Love it. Sounds like a great plan.
Thank you very much for coming on, co-hosting with me, and looking forward to the next one.
Me too.
There we go.
Peace.
Peace.